This is going to be the first globally synchronized fiat-based and debt failure. So the scale of this will be economic history for centuries to come.
You're watching Silver News Daily. Subscribe for more.
Did you know that the next global financial crisis could be the catalyst that pushes silver to historic new highs? It sounds unbelievable, right? But consider this. As we stand on the brink of what could be the first globally synchronized economic meltdown, experts are warning that this crisis might trigger a supercycle, driving silver prices to levels we've never seen before. Imagine a scenario where silver, often overshadowed by gold, becomes the go-to asset not just for safety but for massive gains. In today's video, we'll explore why seasoned market analysts believe this could be the beginning of a monumental shift in the silver market, and why you need to be prepared now more than ever.
I've used a couple of analogies before, Elijah, to answer the second part of your question first. Where do I think we are? I think we've got probably the fastest sprinter of our generation in Usain Bolt, running, literally strolling alongside. We're driving alongside him as coach and mentor to him in the vehicle, and he is literally just striding and loosening up at the moment in terms of my analogy of where he's going. So gold at 2.5 is he's got out of bed and he's got his running shoes on and he's loping alongside the vehicle, and we're preparing for a training session. That's how I think about the 2,500 run. So to be clear, we're closer to 3,000 than we are to the original support at 2,000 that was previously resistance. So we've been appearing for quite an extended period on the show, and we've said, you know, this is going to be a continuation pattern way back, that since 21's highs. You're going to first break the 2K, then you're going to be support on the 2K, and then you're going to set new up legs, which is going to take you halfway, we expect, to the 2.9, 3,000 level. These are all things we've said, and we get plenty wrong, by the way, but in terms of the cycle, this is largely playing out exactly as said in terms of gold. We've not been near as accurate on silver. That it's an extension almost of the cycle, and we can address that later. But in terms of the gold half of things, this is doing exactly what it should be doing. And as I've highlighted before, we did a super targets for gold. You know, the 3K is just the beginning of this major move run. When we do that, we'll have a...
As we delve into the intricacies of the current macroeconomic environment, it's crucial to understand that we are on the precipice of a financial crisis like any other in history. This isn't just another recession or market downturn. We're talking about the first globally synchronized fiat-based and debt failure, a crisis so unprecedented that it could reshape the financial landscape for decades, if not centuries, to come. To grasp the gravity of this situation, let's consider the factors at play. Across the globe, economies are drowning in debt, and the fiat currency system, once seen as unshakable, is now teetering on the brink. The potential for a cascading collapse of financial institutions is real, and the implications for all asset classes, including silver, are profound. But why silver? Why does this metal, often overshadowed by gold, hold such a significant place in the discussion of this impending crisis? Historically, silver has played a dual role in the financial world, both as a monetary metal and as an industrial commodity. This dual nature makes silver uniquely positioned in times of economic turbulence. On one hand, silver, like gold, is seen as a safe haven asset. When financial systems are under threat, investors flock to tangible assets that hold intrinsic value, and silver, with its long history as a store of wealth, becomes an attractive option. However, unlike gold, silver's value is also tied to its industrial applications. In today's world, silver is a critical component in a range of technologies, from electronics to solar energy. This industrial demand adds another layer of complexity to silver's market dynamics, especially during a financial crisis. While the safe haven demand for silver may skyrocket, a severe economic downturn could simultaneously dampen industrial demand, creating a volatile market where prices could swing dramatically. This volatility isn't just a theory. We'd seen it before during past crises. For instance, during the 2008 financial crisis, silver, like gold, initially saw a drop in value as investors sought liquidity. However, as the crisis deepened and faith in fiat currencies waned, silver rebounded sharply, reflecting its role as a hedge against systemic risk. This pattern could very well repeat itself in the coming crisis, but with even greater intensity due to the global nature of the impending economic collapse. Now, let's consider the broader implications of this crisis on the silver market. If we follow the analysis of market experts, including seasoned analysts like Francis Hunt, the signs point to a supercycle, a prolonged period where silver could experience significant and sustained price increases. This supercycle could be driven not just by safe haven buying, but also by a potential resurgence in industrial demand once the crisis subsides and economies begin to recover. But before we get ahead of ourselves, we must recognize the risks. The very factors that could drive silver prices up also introduce significant volatility. A global recession, or worse, a depression, could lead to a sharp decline in industrial demand for silver. In such a scenario, while silver might still benefit from safe haven buying, the overall market could be highly unpredictable, with prices swinging wildly in response to economic news and investor sentiment. This is where understanding the macro environment becomes crucial. The coming financial crisis isn't just a backdrop to the silver market. It's the stage on which silver's future will be decided. As governments and central banks struggle to contain the fallout, their actions, or inactions, will play a critical role in determining whether silver emerges as a star performer or suffers alongside other commodities. Consider, for example, the potential for new regulatory measures or government interventions aimed at stabilizing financial markets. These could have unintended consequences for silver, either boosting demand through increased investor interest or dampening it if industrial activity slows. Furthermore, the response of global markets to these measures could create an environment where silver's price movements are exaggerated, leading to sharp peaks and troughs. In summary, the looming global financial crisis is setting the stage for what could be one of the most volatile and potentially lucrative periods in silver's history. As investors, it's essential to understand the dual nature of silver and the complex interplay of factors that will influence its price in the coming months and years. Whether you're looking at silver as a safe haven asset or as a play on future industrial demand, the next few years could present opportunities and risks that we haven't seen in generations.
Pullback, we'll have a churn, it'll be psychological. The central banks will fret for a while. There'll be a tendency to pull it back from there for a bit. It'll be getting too many headlines, and then we go again. And then we've spoken about 6,800 through 7.5, and right the way. And there's people that have thrown bigger numbers out than me, and they will possibly in due course be right. But we have a technical target for everything we mentioned. So we don't just play who can throw the biggest number, 20K, 25K, given enough time. All these things could turn out right. But we like to have a technical chart that actually is given them. So at that point, we're at 7.5 and beyond. So really the sprint is yet to begun. You're saying with those long legs hasn't even begun kicking his heels back and really stretching those legs and breathing and trying to knock the world record out the park. He is loping. He hasn't even gone into a canter. So the cycle is early. Why do I say that? Because the scale of the collapse is so vast that we're really only in the early stages, and it's a lot longer cycle and process than you think. It's not just 40 years of bond, supremacy and climbing in value that has turned since 2020. It's an entire financial system, and it is more globalized, and everybody is a leper in the leper colony for the first time ever, unlike the Great Depression, which was largely a US stroke to a degree European event, with the rest of the commercial world very much in its own vibe. This is going to be the first globally synchronized fiat-based and debt failure. So the scale of this will be economic history for centuries to come. And that's why I say we're truly just beginning. So it's a fabulous place to be for precious metal stackers in terms of upside. The journey path, socially and geopolitically, it's a little bit more harder to be use such optimistic phrases for.
Historically, silver has been a trusted store of value, much like gold. It has served as money in various forms for centuries, from coins to bullion, and has a deep-rooted place in the global economy. When confidence in fiat currencies erodes, as it inevitably does during financial crises, investors look for tangible assets that aren't tied to the whims of central banks or government policies. Silver, with its intrinsic value, becomes a compelling choice. But silver's appeal goes beyond just being a monetary metal. It has a dual identity, functioning both as a safe haven asset and as a crucial industrial commodity. This duality is what makes silver particularly intriguing and complex in the context of a financial crisis. During periods of financial instability, the demand for safe haven assets typically spikes. We've seen this pattern play out in previous crises, where silver, like gold, benefited from a surge in buying as investors sought to protect their wealth. However, unlike gold, silver's price is also heavily influenced by its industrial uses, which account for a significant portion of its demand. This means that silver's response to a financial crisis can be more nuanced, influenced by both its safe haven appeal and the state of the industrial economy. Take, for example, the 2008 financial crisis. Initially, as panic set in and liquidity became a priority, both gold and silver saw their prices drop. Investors needed cash, and even safe haven assets were sold off to meet margin calls and cover losses elsewhere. However, as the crisis deepened and fears about the stability of the financial system grew, silver, alongside gold, began to recover. The metal's price surged as investors, shaken by the collapse of major financial institutions, flocked to precious metals as a hedge against further economic deterioration. This pattern suggests that in the early stages of a crisis, silver may experience volatility. But as the crisis progresses and safe haven demand increases, silver could see significant price appreciation. This is particularly true in the context of the upcoming global financial crisis, which experts like Francis Hunt believe could be the most severe in modern history. With fiat currencies and debt systems across the world teetering on the brink, the flight to safety could drive unprecedented demand for silver. However, this safe haven demand must be balanced against the potential for a decline in industrial demand. In a severe global recession, industries that rely heavily on silver, such as electronics, solar energy, and automotive manufacturing, could see reduced activity. This reduction in industrial demand could temper some of the gains from safe haven buying, leading to a volatile market where silver's price fluctuates more wildly than gold. Yet, it's this very volatility that presents an opportunity. Silver's smaller market size compared to gold means that when demand spikes, the price can move rapidly. For investors willing to navigate the ups and downs, silver offers the potential for outsized gains, particularly if the crisis is as severe as some analysts predict. Moreover, it's important to consider the broader economic environment. In the aftermath of the crisis, as economies begin to recover and industrial demand for silver rebounds, the metal could experience a second wave of price increases. This recovery phase, coupled with lingering fears about the stability of fiat currencies, could create a perfect storm where silver's dual roles amplify its value. But let's not forget the risks. Silver's industrial applications make it more sensitive to economic slowdowns than gold. If the recession is deep and prolonged, the industrial demand for silver could remain subdued for an extended period, potentially capping its price gains. Additionally, if the financial crisis triggers a deflationary environment, where prices for goods and services fall, silver could face downward pressure as a result. These risks highlight the importance of timing and strategy when considering silver as a safe haven investment. For those looking to protect their wealth, silver offers a unique combination of stability and growth potential. However, it also requires a keen understanding of market dynamics and the ability to withstand periods of volatility.
At a yield curve inversion, it's 100% indicator. And the other thing that's so much more relevant about this indicator is, unlike the Fed that watches labor statistics, which is a major lagging indicator, which is why they're always late to cut. There's more reasons why they want to be late to cut, and we can touch on those in a minute. But this is a leading indicator. It tells you in advance that you're going to be hitting troubled waters. You can see 89s here for the early 90s slump, which had the Asian crises over there. You can see you actually dipped in 97 before the dot-com crisis. You can see in 2006, you first went under and you reverted twice. But eventually the final one here in the early part of 2007, at this point over here, only for the Lehman crash to occur 08. You can see here with CB19, we had the repo markets problems here in 19. One event actually just went up below the zero before January 2019, and we dipped under again on the middle of 19 as we were heading to the late H2. So August for September and October, where there was repo-based issues. And then we went bang, CV19. Now this has been the longest reversion, or my apologies, inversion, that is below the zero, that has yet to revert. And we touched on the tremor of the yen, but it wasn't enough to take us back, telling me we're getting close to the point where we revert above zero, and that the big crisis and the main enchilada is still to come. So I can't say for absolute certainty anything when we're talking about the future, but my overall on balance of probabilities-based assessment is we're yet to have a major macro event. Now, that could be MPOX or something else, war, there's so many down risks that are on tenterhooks that could fall, that could be major scale events, banks, etc. The debt, it could be financial, it could be a second stage in the yen unwind, starting to involve derivatives. We're seeing the dollar lose back against the yen again, which is again still part of the fear that tells me the narrative that everything is done with the carry trade is quite potentially not true. If that was the case, we should be...
Currently, silver is positioned within a broadening formation, also known as a megaphone pattern. This pattern is often a continuation signal, suggesting that after a period of consolidation, silver may resume its previous trend, likely an upward trajectory in this case. However, this pattern also indicates that the market could experience significant volatility with wider price swings as the pattern develops. One of the key levels to watch is the $26, $28 per ounce range. Silver has been trading within this range for some time, and a decisive break above $28 could signal the start of a new bullish phase. This would be an important confirmation that silver is ready to move higher, potentially breaking out of the frustrating range-bound market it has been stuck in. However, there are also risks. If silver fails to break through these resistance levels and instead drops below key support levels, around $22 per ounce, it could signal a potential downturn, especially if industrial demand remains weak. This could result in a period of further consolidation or even a decline, depending on the broader economic environment. Francis Hunt has pointed out that the frustration of silver bulls is understandable, given that the market has not yet broken out as many had anticipated. But this period of consolidation could be setting up for a significant move, especially if macroeconomic conditions align in favor of silver. The key is patience and vigilance. Watching these technical levels closely could provide critical insights into the next major move for silver. In summary, the technical picture for silver suggests that while the metal is in a phase of consolidation, the potential for a breakout is very real. Keeping a close eye on the $26, $28 range and other key technical indicators will be essential for investors looking to capitalize on silver's next big move. In the next step, we'll examine governmental and regulatory risks that could impact the silver market, adding another layer of complexity to the already volatile environment.
Reverting back up strongly, and in actual fact, this is what we're getting on the USDJPY. Let's just take it on a lower time frame. You can see that sell-off over there. And just as an interesting speculative point on the USDJPY, we've drawn something else here for you that's kind of interesting. This is a neckline that we've thrown down on the 142 level. You've got a potential left shoulder there. You've got a long, slow grinding head with a very violent sell-off there. You've got a weak rally here, and we're actually looking down again. We could bounce a second or a third time around here. But if we throw down again on the yen carry trade, you can forget about all notions that 75% has been unwound. That's misinformation, misdirection. From the usual mainstream media sources, you could be in a head and shoulder structure for a lot deeper. That points to a real weakness in dollar. And that's what they might need to keep the debt valuations up. In other words, where we were different, Japan was the one that was keeping their debt market up largely with not many changes in interest rates and taking all the hits on the currency. It's now the dollar's chance it could be, because the Japanese have now raised rates. That's the devaluation of debt. Remember that. So it's never, that's what my criticism of people that are, dollar milkshake supremacists, your currency going up is not everything is awesome if it's on account of interest rates going up and your debt losing value at the fastest rate compared to everyone else, because people stop buying your debt if the capital gains is going to revert so chronically negative. So in this sense, we might be getting a sustained period of dollar weakness. We'll see what happens here, but the USDJPY is a fear indicator for the carry trade. And after a small bounce, we are in fact heading down again. And that 142 is a key watch level because it's where we bounced in the extreme volatility. Do we bounce again? Will we rally away from it? And maybe a double bottom and start going back up? Or do we form a continuation pattern, which is a time bomb for second wave? And I would probably say there's a chance we're in that latter category. So let me hand back to you then.
As we delve further into the factors that could influence silver's trajectory during the coming global financial crisis, it's important to consider the role of governmental and regulatory risks. In times of economic instability, governments often take measures aimed at stabilizing markets and protecting their economies. But these actions can have unintended consequences for the silver market. One potential risk on the horizon is the introduction of new regulations or changes to existing laws that govern the trading and ownership of silver. For instance, there has been recent discussion about changes in the dating of silver bars on major exchanges, such as the New York and Chicago mercantile exchanges. Beginning in 2025, silver bars will be required to have their year and month of minting stamped on them. While this might seem like a minor change, it could signal broader regulatory shifts aimed at tightening control over precious metals. But why does this matter? Changes like these could pave the way for more significant interventions, such as increased taxes on precious metals or restrictions on ownership and trading. If governments, especially those under financial strain, decide to impose stricter regulations on silver, it could create short-term volatility in the market. For example, restrictions on older, undated bars could lead to a supply crunch, driving prices up as investors scramble to acquire compliant silver. Furthermore, monetary policies implemented by governments to address the financial crisis could also impact silver. If central banks continue with aggressive monetary easing, it could lead to inflationary pressures that would boost demand for silver as a hedge against currency devaluation. However, if governments introduce policies that dampen precious metals trading, such as higher capital gains taxes or restrictions on physical silver ownership, this could negatively impact demand. Francis Hunt has highlighted that these types of regulatory risks could be part of a broader strategy by governments to maintain control during the crisis. These measures, while intended to stabilize the economy, could have the side effect of creating uncertainty in the silver market, leading to increased volatility. In summary, while silver has strong potential as a safe haven asset, it is not immune to governmental and regulatory risks. Investors need to be aware that new laws and regulations could introduce volatility, either by restricting access to silver or by driving up demand through tighter supply. Monitoring these risks will be crucial as the financial crisis unfolds. In the next step, we'll explore speculative sentiment and concerns about market manipulation, further adding to the complex landscape that silver investors must navigate.
I'm going to answer your question on gold. I'm going to be a tiny bit cheeky and I'm going to throw in another commodity just to cross-reference gold so that everybody can have a little bit of a compass, because understanding relative valuation is super important. We call it the 360-degree analysis that you want. Then I'll give you the pure gold versus the dollar side. But I want to highlight that this just further adds to, given your question, it further adds to the concept that we are in a state of great weakness, and that people that think that the labor economy was saving us from being in a recession, when they redefined what a recession, should think again. We've had a lengthy period on oil. So I will be answering your question on gold, but I'll be first highlighting this. We've had a lengthy period on oil, and we do have a bit of a reputation for being the oil short callers. We've had two major calls, one just before the CV19 and one in July 2014 on macro timeframes, both of which turned to absolute bloodbaths in oil. And I contrast oil because I have a lot of friends that are in the energies-based commodities because of the commodity super cycle, and I keep going, it's a debt-based fiat crisis, debt and fiat. This is a monetary metal bull market. It is also suppression of retail, consumer, and everything else. It is not a wealth enhancement liquidity event yet for that part of the market. That is destroying purchasing online, deliveries, general activity, and that we've seen copper crash, which was in our Substack as a leading indicator. We've seen lumber for US house buildings come down brutally. And now I'm showing you oil. And I actually, when the yen trade unravel began, I said that if you want a delta neutral trade, gold long, oil short. It's that time again. And that was our CV19 trade, by the way, as well, which was actually even stronger than just oil short, because you made upside on the gold. There was a small dip for CV19, but you went on to make the 21 high, and you actually saw oil hit zero in the cash markets and go negative in the futures markets on account of storage. So this analysis is happening again. And it's very much related to...
As we delve into the silver market's potential during the looming global financial crisis, it's crucial to address the role of speculative sentiment and the pervasive concerns about market manipulation. In a market as volatile as silver, these factors can significantly influence price movements and investor behavior, adding another layer of complexity to the investment landscape. Speculative sentiment plays a pivotal role in driving silver prices, especially during periods of economic uncertainty. When investors anticipate a crisis, many turn to silver as a hedge against inflation and currency devaluation. This rush to secure a safe haven asset can drive up prices rapidly, creating a self-reinforcing cycle where rising prices attract more investors, further pushing prices higher. However, this speculative behavior can also lead to heightened volatility, with prices subject to sharp swings as market sentiment shifts. But beyond the natural ebb and flow of market speculation, there are growing concerns about deliberate market manipulation, particularly in the context of silver. Some analysts argue that the silver market is being artificially suppressed, pointing to unusual patterns in volatility indices and rapid responses that seem designed to prevent market panic. For instance, the swift suppression of the VIX index, an indicator of market volatility, during periods of heightened economic stress suggests that there may be efforts to maintain an appearance of calm, potentially preventing silver from reaching its true market potential in the short term. These concerns are not unfounded. Historically, There have been instances where large financial institutions have been accused of manipulating precious metals markets to maintain certain price levels or to benefit from market movements. In the case of silver, some believe that similar tactics could be in play, with efforts to keep prices subdued in order to protect other financial interests or to prevent a broader market panic. Francis Hunt has emphasized that such manipulation, if it is occurring, could frustrate silver bulls who are expecting a significant breakout. However, he also suggests that this could be setting up the market for an even larger move once the constraints are lifted or if the manipulation fails to contain the upward momentum. The pent-up demand, combined with the natural pressures of a financial crisis, could eventually result in a sharp and rapid rise in silver prices, potentially catching many investors by surprise. For investors, the key takeaway is to remain vigilant and to recognize that the silver market may be subject to forces beyond simple supply and demand dynamics. While speculative sentiment can drive prices higher, the potential for market manipulation means that prices could remain volatile and unpredictable in the short term. Understanding these risks and preparing for potential sudden shifts in the market will be crucial for navigating this complex environment.
And if, God forbid, we were to get climate-based, mpox-based, or anything that restricts activity, flying, or anything else again, are we seeing the markets are a future forward-based thing? And I was listening to other people talking about backwardization in oil, in that 2025 oil and 2026 oil is actually cheaper. What do the markets know right now? That cash oil is selling off. Futures oil delivery is actually lower than current. What do they know? It's almost like a yield curve inversion for demand in a highly consumer significant commodity that is deeply part of the inflation number. And the one thing they need is to kill that inflation number so badly that they can justify quantitative easing again. Again, this points to another demand-destroying event for this. And we actually, on the oil market, have both an inverted HVF downside target, but if the larger head and shoulder plays out, you could be in at 32. So let's go back to your original question. How's it looking technical on gold? Well, relative to oil, I think gold is going to be doing far, far better. But if we have a supremely significant demand-destroying event, it will still have a moment where it can sell off. But if you have, as the trade, and I'm a trader, investor, and long-term holder of gold, so this is more for those that like a little bit of speculation, you can protect yourself against the downside of gold by being short oil. Because my take is whatever gold dips to the downside, oil's going to have a multiple beta to that. So there's a little bit of an insurance in that trade by being delta neutral to the commodity class. But broadly speaking, we've broken up out of a rising wedge, which is often characterized as a bearish setup. And it isn't. You can go to the high side. This was another example of a potentially bearish setup. And as you can see, you had a melt-up event out of that. You made marginally higher highs here, but you couldn't hold them. And this was essentially a continuation pattern over here from the 2000 call that we gave on your channel some time ago now. It would have been March of this year, I think, that we were sitting on 2000, that we had the lovely squeeze. So you are seeing almost a bigger version of...
As we approach the end of our deep dive into silver's potential during the impending global financial crisis, it's time to focus on short-term predictions for silver prices. Given the complex interplay of factors we have discussed, ranging from the macroeconomic environment and industrial demand to speculative sentiment and potential market manipulation, it's clear that predicting silver's immediate trajectory is challenging but crucial for investors looking to navigate these uncertain times. In the short term, silver is likely to continue trading within its current range of $22 to $28 per ounce. The ongoing macroeconomic uncertainties, including fears of a global recession and the potential for demand-destroying events, could keep silver from breaking out in either direction. However, this range-bound trading may not be entirely negative. It could provide a consolidation period where silver gathers momentum before making a significant move, especially if economic conditions deteriorate further. If the global financial crisis deepens and the gold-silver ratio begins to decline, we could see silver prices breach the upper end of the current range, moving toward $30 per ounce or higher. In this scenario, silver's safe haven appeal would likely drive demand, particularly if inflationary pressures increase or if faith in fiat currencies continues to erode. The pent-up speculative sentiment we discussed earlier could also fuel this rally, leading to sharp price increases as investors seek refuge in silver. Conversely, if a severe economic downturn drastically reduces industrial demand for silver, we could see prices fall below the $22 per ounce support level. This bearish scenario might unfold if the crisis leads to a deflationary environment, where prices for goods and services drop, reducing the need for industrial commodities like silver. Additionally, if market manipulation efforts successfully suppress silver prices, this could also contribute to a downturn, delaying any potential rally. It's important to note that regardless of which scenario plays out, silver is likely to experience significant volatility in the short term. The factors we discussed, macroeconomic risks, industrial demand, speculative sentiment, and potential regulatory changes, create a complex environment where prices could swing dramatically. For investors, this means being prepared for sudden shifts in the market and maintaining a flexible strategy that can adapt to changing conditions. In summary, while the short-term outlook for silver is marked by uncertainty and potential volatility, there are clear scenarios that could lead to either significant gains or further declines. Monitoring key indicators like the gold-silver ratio, industrial demand trends, and market sentiment will be crucial in anticipating these moves. As we move forward, staying informed and ready to act will be essential for capitalizing on the opportunities and navigating the risks that lie ahead.
This occurring here. We've gone up, okay, little bit of news headlines, we've gone back down. This is a hammer, so we tested down, we've come back up on the short time frames. Gold is looking healthy to me, and if this macro turns out to be anything like this guy, you could be looking at quite an impulsive move to the upside by scale. And don't forget, our next stop targeting is 293,000. And you're no longer, you're closer to those levels now than you are to the original 2K balance, as we're trading at 2,510 at the moment as we're speaking. So I think it looks really good for gold, and I'm happy to be long without the oil short. I just find the oil short actually has a potential to take a little bit of edge off in case we get real drama where there's a rush for liquidity because people are forced sellers, and also an opportunity to make some extra alpha on the downside on what looks like a very weak oil price. So I've hopefully answered your question and added a few other wild cards in there.
Definitely. And it obviously, when we do see demand destroying events, this seems to hurt silver more than gold. What is your outlook for silver? And if we do see this event, do you see that silver could be hit quite a bit?
Yes. And it's a great question. And I want to come back to where we had a view on the gold-silver ratio. We'll finish on the gold-silver ratio. But broadly, I will argue for now, until such an event occurs, you are just in a very similar, almost to Bitcoin, broadening structure, which is typically continuation upside. So that's your bull pole, and that's a megaphone. So if you just look at the pink lines that I've drawn there, to not overwhelm people that are not typically technical, I'll just turn the rest off. You've had a bullish move, that's your pole, that's your descending megaphone. Overall, it's led to around a 50% retrace, I would guess, from the lows to the highs. And now you're actually moving, I would imagine, to the upside of that capping descending grind line, which is the top side of the megaphone again, until that demand destroying event occurs, or if it occurs, we will see. And it's difficult to put timings on it. When will the yield curve revert is the answer to your question. And until then, as long as copper stays low and is selling off, lumber staying low, There is an industrial component to silver, but silver does also have the monetary component to it and has recovered fairly well. But the gold-silver ratio is still high, and we want to see this rollover.
As we shift our focus from the short term to the medium to long-term outlook for silver, it's crucial to consider how the various factors we've discussed might evolve over the coming years. The global financial crisis we anticipate could significantly reshape the economic landscape, and silver, with its unique characteristics, stands to play a pivotal role in this new environment. In the medium to long term, if the global financial crisis materializes as expected, silver is likely to see steady gains. As investors seek alternatives to fiat currencies, which may be increasingly devalued by aggressive monetary policies and inflation, silver could emerge as a key store of value alongside gold. In this scenario, silver prices could gradually rise towards the $35, $45 per ounce range over the next 1 to 3 years. This would reflect a normalization of the gold-silver ratio as silver catches up with gold, driven by both safe haven demand and a recovery in industrial usage as economies begin to stabilize post-crisis. If the crisis triggers a prolonged period of economic instability, accompanied by high inflation or even hyperinflation, silver could enter a historic bull market. In this scenario, silver could potentially retest its 2011 highs of around $50 per ounce or even exceed them. The confluence of factors such as sustained high demand for silver in green technologies, continued investor interest as a hedge against inflation, and a weakening of global fiat currencies could propel silver into new territory. Some market analysts, including those like Francis Hunt, suggest that if the anticipated supercycle in commodities takes hold, silver could even reach levels as high as $100 per ounce within the next few years. However, there is also a bearish scenario to consider. If the global financial crisis leads to a long-term depression, characterized by sustained low industrial activity and deflationary pressures, silver might struggle to hold its gains. In this case, silver could settle into a lower trading range of $20, $25 per ounce. The prolonged economic weakness could suppress industrial demand for silver, outweighing the benefits of its safe haven status. Additionally, if governments impose stricter regulations on precious metals trading, or if market manipulation continues to suppress prices, silver could face ongoing challenges. One of the key themes in silver's medium to long-term outlook is volatility. Even in a bullish scenario, silver is likely to experience significant price swings due to its dual role as both a monetary metal and an industrial commodity. Investors should be prepared for periods of sharp gains, followed by corrections as the market reacts to economic news, shifts in investor sentiment, and changes in industrial demand. Despite these challenges, the long-term prospects for silver remain strong, especially for those with a multi-year investment horizon. The potential for silver to outperform during a financial crisis, coupled with its critical role in emerging technologies, makes it a compelling asset for those looking to hedge against economic uncertainty and capitalize on the next wave of industrial growth. In summary, silver's medium to long-term outlook is marked by both significant opportunities and risks. Whether the metal experiences steady gains, a historic bull market, or struggles amidst prolonged economic weakness will depend on the trajectory of the global financial crisis and its impact on both the monetary and industrial demand for silver. As we move into this uncertain future, staying informed and adaptable will be key to navigating the silver market and making the most of the opportunities it presents.
And you may recall, and I would say our initial hunch of what might be going on there has extended a little bit, and that it's not going to come as soon as we'd like. So again, what does that tell me? You may recall we felt the break of this level was very significant here. It was, but it didn't continue. It based and it returned quite violently up here with the yen carry trade unwind, which has the industrial element. So I think the fear of demand for it in cars, whatever the case may be, other jewelry, etc., was sufficient to hurt silver more than gold, and that brought it back into this zone. But we did meet the high point here again, so we've got again a sort of a falling wedge structure, I would say. I'm going to take you up to the monthly. That's kind of a slightly bigger view. We really want to flip from our gold back into silver when we run and we start getting to the red line here, Elijah, which is 65. That's the break we want to see. This is a shooting star. So silver, now that it started going up, is reining back gold to a degree. So I would expect to see it work its way down in here. But once it gets to the low end, if it gets supported back again, we can go back up. So we're still in a holding continuation. This has been really frustrating for the silver bulls, because since that moment here and that sell-off, you've actually been in a range that has been tightening and continues to tighten. And the longer you're in that, and as impatient as it makes people, the better the move in the end. You know, you've kind of been in the 75 to 92 range, but it is tightening and it's turning down a little sooner. How much lower? Will we probe a little bit lower? The release of the 65 will be significant. But the one concern I do have for that is if we get a demand destroying event, let's say for now we come back to the other side, but we then have a major crisis, a lockdown, climate, pox, banking failure, second stage yen unwind. You could.
As we reach the culmination of our analysis, it's clear that the global financial crisis on the horizon is poised to have a profound impact on the silver market. The factors we explored, from the macroeconomic environment and industrial demand to speculative sentiment, market manipulation, and regulatory risks, all point to one conclusion: silver is on the brink of a potentially historic transformation. The anticipated crisis is not just another economic downturn. It's a globally synchronized fiat-based and debt failure, an event of unprecedented scale that could trigger a supercycle in commodities, with silver at the forefront. As fiat currencies weaken and inflationary pressures mount, investors will likely turn to tangible assets that offer protection against currency devaluation. Silver, with its dual role as both a monetary metal and an industrial commodity, stands to benefit immensely from this shift. The current elevated gold-silver ratio suggests that silver is undervalued relative to gold, setting the stage for a significant correction as silver begins to catch up. If the financial crisis deepens, we could see silver break through its current trading range and embark on a powerful upward trajectory. In the short term, this might mean prices rising toward $30 per ounce, but in the medium to long term, the potential for silver to reach new all-time highs $50 per ounce or even higher is very real. However, the road ahead is not without challenges. Silver's dual identity means it will likely experience significant volatility, with prices subject to sharp swings as the market reacts to the ongoing economic turmoil. Industrial demand could be a double-edged sword, with a severe recession dampening demand in sectors like electronics and automotive, potentially offsetting some of the gains from safe haven buying. Furthermore, the potential for governmental interventions and market manipulation adds another layer of complexity. Regulatory changes could introduce short-term volatility, while efforts to suppress market panic might delay silver's ascent. But as we've discussed, these constraints could also set the stage for an even larger move once the market's true dynamics are unleashed. For investors, the key to navigating this environment will be a strategic, long-term approach. Understanding the interplay of silver's monetary and industrial roles, monitoring the gold-silver ratio, and staying alert to regulatory and market changes will be crucial. Those who can manage the short-term volatility and stay invested through the ups and downs stand to gain the most as silver potentially enters a historic bull market. In conclusion, the coming global financial crisis could be the catalyst that drives silver to levels we'd never seen before. The combination of a weakening fiat currency system, rising inflation, and the recovery of industrial demand post-crisis could propel silver into a supercycle, with prices reaching $50, $100, or even higher in the coming years. While the journey will undoubtedly be volatile, the potential rewards make silver an asset that deserves serious consideration as part of a diversified investment strategy. As we move forward into this uncertain future, staying informed and adaptable will be more important than ever. Keep a close eye on the developments in the silver market and be prepared to act when opportunities arise. And remember, this analysis is not financial advice, but rather a guide to help you understand the potential risks and rewards in the silver market. For more insights and updates, make sure to subscribe to our channel and stay tuned for our latest analyses.
Go rushing back up to the other side there, and we don't want to see it break out of that structure to the upside, because that would point to a lot longer extension. And so my overall tiny tweak, if I may, is keep buying the gold ounces. Just get stacked and loaded with gold. Then we can start pivoting. I already have a silver allocation. We can start rotating into silver once we have clear evidence that we are going to the downside and getting ready for the 65 break. Because at that point, that's when I think things will capitulate materially to significantly in our favor. And the fact that this is being pushed out tells me that this is a far bigger event. We've moved, you think stage 1 is over and you're already wanting to go, everybody is second guessing stage 2 and 3. You're still in stage 1. This is just the beginning. And that's why I refer you back to the Usain Bolt analogy. He's literally warming up. He's walking next to the car, stretching his quads and moving his arms around. He's not even begun to load. And we've got to stay with gold, and then rotate when we have clear. People will say, look, you're going to get a bit of a higher beta now for silver, but we want to see it break. I don't want to trade the swings inside of this so much. Okay, if you want to load up on silver, you probably do a little bit better over the next few weeks or maybe a month or two. But it's what's going to happen in 6 months. It depends on your timeline. If you're a day trader, buy silver now on the shooting star, not gold. If you're investing for holding, for seeing through the full reset period, again, there's a chance we break this to the high side, and you will have a clear signal for pivoting into silver. Keep stacking the gold. That's how I would put it, because it's the monetary failure, and gold has the highest percentage of money, replacement money.
I think that's a good maybe ending point, is that it's a monetary failure, as you mentioned. Really, it's important to look at the big picture as well, like what